Thank you for tuning in. Our next presenter is Cameron Watt, President and CEO of Intouch Insight. Mr. Watt, you may begin.
Thank you. And thank you all for listening today and being part of the SNN conference. As she said, I'm the President and CEO of Intouch Insight, and we'll spend a little bit of time going through a quick corporate overview and presentation, and at the end of which I will be happy to answer any questions that you might have. Of course, I have to put this slide up, which is the safe harbor legal disclaimer regarding forward-looking statements and other things like that, which I'm sure you're familiar with and you get to see all the time. And we will move from there on to a little bit of mission and values. I want to spend a little bit of time on this. It's not necessarily normal in all investor presentations, but our mission here: create shareholder value by designing, building, and delivering solutions that collect data for customers and provide information that improve business outcomes. It's something I'll talk about as a bit of a theme in terms of that value part of creating value for our customers. And our own values are results-oriented, resourceful, quality-focused, and integrity-driven. In no time in the past, probably has having a really strong team and a really strong culture been more important than it was in 2020. We faced in 2020 challenges as a world population, as countries, as citizens that is unprecedented in most of our lifetimes. And I can tell you that I am incredibly proud of the team at Intouch and how they adapted, how they remained committed and came through. In the entire year of 2020, we actually only had one unforced turnover that we had to replace during the year. So, very, very strong team, very, very strong culture, and we believe in our mission and values. The board of directors is only 5 people. It's a very small, efficient, and effective board. And you'll see as I go to the next slide that Michael, Eric, and myself are actually the 3 largest individual shareholders in the company, which is the next slide. Only 22.65 million shares. We have a 31% insider ownership. Eric Butel is our largest shareholder. Myself, I'm behind him at 10, and then Michael at 6. We have we have a good number of free-floating shares, but we keep a very tight float. We've actually only done one capital raise since the original IPO almost 20 years ago, and that was in the fall of 2017, so we try to keep things as tight as possible. You'll see that in terms of who we are, what we do, we were founded in '92 doing survey work. At the time, the internet wasn't prevalent, so it was actually kiosks that went around to do customer surveys in locations like Bob Evans, et cetera. We have roots going back to 1978 in our services business through acquisitions. And as I said, we've been public for almost 20 years. Valued then comes up again as a theme. The one thing that we have going for us always have is that we are valued by the people who we serve. We actually help our customer base to improve their customer experience, which helps them increase their sales, which is value. We help them improve their business processes. We help them ensure regulatory compliance. We make sure that they can deliver effectively day to day and that they can stay in business and stay on the right side of things. We also capture information from a lot of different sources. Besides our own services and software, we also bring in external data, whether it's social media, whether it's their call center data or financial data. We can bring it all into one place and do analytics on that information, and again, provide them the information they need to improve that customer experience and to increase those sales. So the question is, how do we do that? Or in another phrase, what do we do? Right? Well, let's talk a little bit about what we do. We have 2 main branches within our business. We have recurring services and we have recurring software. The recurring services business is mystery shopping, compliance, and operational audits. When you think about these recurring services, what really we're doing is we're capturing data points to verify an organization's execution against standards. If you take a look at a restaurant chain or a convenience store or a grocery store, they might have 10 or 100 or 1,000 or 2,000 locations out there, and they are all supposed to be doing the same things in basically the same way. That's what a brand looks to do. It's difficult to know from the head office, even from the district office, if the standards are being maintained all the time. We go out and we collect data points that let our customers know in which locations and at which times our standards are being upheld and at what level are those standards being upheld. And we can do that not only for things like wearing a mask, like whether people are smiling and being friendly, but also whether people are following all sorts of operational and detailed standards right down to expired products, temperatures, you name it. There's lots of health and safety work that we do as well. So those are data points around adhering to the standards set out by the organization across many, many, many locations and making sure that they're maintained. It's a brand protection exercise. It's a customer protection exercise. The software, which we've launched most of this within the last few years, is now designed to collect additional data points, but these data points are less around standards and more around the customer and more around how the customers feel about the standards. Our survey platform does basically what you'd expect from a SurveyMonkey or a Qualtrics or Medallia or anybody else that you've seen out there doing surveys. It's a very robust product. In fact, just this week, we launched a COVID-19 health check for organizations to use to help bring their workforce back into their offices while adhering to CDC and Health Canada guidelines, which allow them to do so without having to worry as much about workplace outbreaks and being able to trace what people told them and when they told it to them and basically adhering to guidelines. And we used our survey platform for that. The forms and checklist automation product actually automates any kind of form or checklist or manual process the companies may have been doing on pen and paper or ad hoc. It actually allows them to do it through a software, including taking pictures, annotating those pictures. It's a very robust piece of software. And you add those together and you roll in some other data and you wind up with the full customer experience management platform, LIA-CX, which stands for Listen, Interpret, and Act. Listen being that you're collecting data. You're listening. Whether it's listening to your own operations or whether it's listening to your customers, you're listening. And you're bringing that information in together. You then have to interpret that data and then act on that data. And we can do all that from within our platform because inside that LIA-CX Customer Experience Management platform, you can not only bring in survey data, you can bring in services data, you can bring in external data, you can do the analysis, but now you can also launch a checklist. You can launch an action campaign, is what we call them, and you can actually have your teams go and do things to improve what you're trying to improve. And you can look to see whether or not that improvement happened. And that's all done within this recurring software. And and all of these are sold, those products are all sold on a SaaS software basis, on a cloud-based basis. The event marketing automation software at the end is a more of a legacy software that we've had for well over a decade now, and it still makes up a good percentage of our software sales. It's not our focus moving forward, as it is more of an enterprise type of software. We're focused right now on growing that SaaS software, which is obviously where we see the future. It also ties in really well towards our recurring services. So it's no surprise if you look at what we do, that who we do it for are primarily location-based industries in terms of our focus. We have a lot of convenience stores and grocery, restaurants, hotels. We have a lot of places where people need to maintain a brand standard across a very broad group, very broad spectrum. And the great thing with that is that it allows us to work with some really cool brands, some really big companies, and people have typically heard of our customers. Taking a quick look at some highlights, we had a little over 2/3 of our revenue so far in 2020. This is three-quarter data. Was in the United States, the rest in pretty much in Canada, a little bit outside. We have had over 75% recurring services with over 23% recurring software at this point. We have very big brands, as I mentioned. They're very large companies, very well known. We also, as a result of our history, we've had virtually no attrition since 2013 in terms of revenue through 2019. And as you can see, in what we've achieved this year, we have a very experienced management and financial controls in terms of where we sit today as a company. From a revenue standpoint, historically, if you go back and you look at 2014 through 2019, now 2020 is a bit of a unique situation. I will talk about that specifically in the coming slides. If you look at the previous 5 years, we grew 130% with an increase in revenue in every single year. The trajectory was very strong. From a historical milestone standpoint, in 2014 we were doing about and these are Canadian dollars now, $8.5 million in revenue, 45 employees. In the next 3 years, we reinvested our internal cash flows. We retooled the business to build and sell software in parallel with our services. We launched our first ever SaaS product with Intouch Check. In 2017, based on the success and the trajectory of those products, we announced that we would go into the customer experience management product space. Ultimately, that became LeaCX. We did our like as I mentioned, our only raise since we went public in 2002, and that was $3.5 million. We invested that growth capital into our product. We launched LeaCX. We expanded development, sales, and support teams for those products in 2018. And in 2019, we saw the fruits of that labor. We started to see 29% revenue growth to $19.3 million. We had EBITDA of over $1.5 million while we continued to expand our SaaS product capabilities. And then 2020 rolled around, and I'm going to call that a pandemic pause on growth. We had to cease investment in our SaaS transition and focus again back on our base business delivery. We returned strong profits and EBITDA despite significant revenue losses, but we did have to put things on pause. What does that look like? Well, we talked about 2019 and 2020. The early trajectory for 2020 was we had multiple acquisitions. We had $25 million sales forecast. We had $30 million in expected year-end run rate. We had strong EBITDA, good financial controls, and we had continued product innovation going on. In the beginning of March, honestly, the future's so bright I have to wear shades. Then the world changed, and we had to change with it. We had to refocus. And we did some very tactical things as a response. We furloughed 50% of the workforce and put our acquisition on hold our largest acquisition on hold on March 23rd. In April, we utilized government programs, and we brought our entire workforce actually back onto payroll. And then April through September, employees, executives, and the board of directors all committed and contributed $600,000 in earnings. At the same time, we reduced our workforce by 28%. On October 1st, we actually issued restricted share units to compensate for lost earnings, and at the same time, that compensation, people had to wait a year. So we secured all of those people to stick around for a full year so that we could actually recover with the same people, with the talent that we would need. So we did a lot of very tactical responses that worked very well because we had to refocus. We shifted our focus on product. It's very difficult in a pandemic when people are wearing a mask to tell whether people are smiling and friendly. But we actually shifted, and what we did was we went and we started measuring things like, did the location have hand sanitizer available? Did they have floor markings for social distancing? Was there the right number of people in the store? Was there lineup outside the store? There was a lot of things we started measuring this year that we didn't have to measure before 2020, but we adjusted and we adapted and we worked with our customers. At the same time, we had to make sure we maintained strong partnerships with this customer base. We had a very long tenured customer base. As I said, we haven't had, attrition. That hasn't been something we've had to work with. That's part of the reason our growth story has been such a good success, is it's much easier to grow if you don't lose the customers you have. And so we had to make sure that we could rebound with these customers in the future. So we allowed all of our customers, without any type of, issues or politics or paperwork, to put programs on hold as they wanted to during the year, whether it was for a month or 3 months or 6 months or for the entire year. We just let people put things on hold while maintaining their contracts because we didn't want to and haven't lost any contracts. And now we're working with those people and have been working with those people to recover, and that's why you saw our revenue decline be much less in Q3 than it was in Q2, and we'll continue to recover as people come back, as the world reopens, as the economies reopen, as businesses reopen. We'll continue to bring our programs back online because we focused on making sure we maintain those really strong partnerships that we have with our entire customer base, and we still have those today. We also worked on financial controls and self-sufficiency. We prioritized it, in fact. The last thing that we wanted to have happen was be in a situation where we had to ask for money at a time when money was going to be expensive and dilutive to our shareholders. We take the concept of dilution very, very seriously. We take the concept of shareholder value very, very seriously. And so we made sure that we were financially secure, which we did a fantastic job of doing, and we're fine. As you can see in all the different statements, there's cash in the bank, and we're EBITDA positive. So that sets us up really well for 2021, which is recovery, right? We need to invest in and focus on that SaaS product transition from new product lines again, which we have already started doing. I've said in previous MD&As and things that we've started that actually a little bit in Q4, but really heading into Q1, we're focused back against our SaaS products. We're going to continue working with that client base that's still with us towards a full recovery of those historical programs, and we also going to look at opportunistic M&A. At the end of the day, not every company may have come through 2020 as well as Intouch Insight did, and that may present opportunities. So if we take a look at the highlights of 2020, there were some notable highlights. Given that, we had a 37% revenue decline, I think some of the things we achieved really illustrates that management capability, customer stability, and underlying business strength. We had a 53% growth margin, $1.4 million in EBITDA, almost all recurring revenue, no debt, current ratio of over 2, and less than $5,000 we had to write off due to poor quality AR despite a global pandemic. So 2020 has been, by all accounts, a successful year, although disappointing on a lot of global reasons, including growth for us. The question I then get asked is, sure, but you're working with location-based industries, you're working with industries that are struggling. How are you preparing for the future? And the answer is really quite simple. Our software is already new and it's evolved. LeaCX, Survey, Check, they're all very modern. They've all been launched and renovated in the last couple of years. They're being worked on all the time. And they're applicable whether you serve customers from 1,000 of your locations or whether you start serving from 3 central warehouses. That doesn't change. The software can handle many new applications or trends, such as the COVID checklist that we recently launched for organizations to use. And we've also taken a look at reimagining our services because today we're measuring new channels. Those customers that we deal with are massive companies. They're not going anywhere. But they're starting to look at how do they deliver differently for their customers. But we're working with them on that. We're already measuring curbside pickup and takeout delivery, online ordering. We're measuring those things today. Even if you start to use a third-party delivery service to deliver your goods, you still want to measure the service level that you're getting from your third-party delivery service. So we are working with the industries that we work with as they change to maintain new services. Because at the end of the day, how people engage with customers is going to evolve. But the fact that people have to engage with customers, the fact that people have to provide, services and have to provide goods, that's not changing. And we can measure that, however that transaction takes place. And we're also unbounded. Yes, we're focused on location-based industries, and we're focused for a reason. We'll remain focused for a reason, and that reason is that we want to have that competitive advantage. We want to continue to win when we are playing in our space. But the software and services are completely industry agnostic. They may be used to assist any type of business, even businesses that are still being developed and thought of. At the end of the day, it's not that we have to only do the location-based industries, but that's where we win most of the time. But we're open, and we're available for any businesses as they come along. So we are not only ready for the future, we welcome the future and where the future is going. We think it's great, and we think we're in great shape for it. Well, we take a look at 2021 value potential then. As we look at our share price and our stock valuations, we look at it that we're typically valued by investors based on being a services business. That's where our proven track record is. That's where that stable, profitable, underlying business is, and that's where we're typically valued on that basis. But we've made significant investment into our SaaS software products. Those products are available today. They fit our existing client base, they fit our target industries, and we're going to only get stronger as we get out there. When you combine that proven track record and customer relationships with that strong SaaS capability, we expect it to yield strong results. So therefore, as software traction accelerates, there's an opportunity for our valuation to improve, not only because our revenue is going to increase, and as our revenue increases, our value should increase, but also as the multiples on that revenue start to go towards SaaS-based company multiples instead of a service-based company multiples. There's a huge value potential available with Intouch Insight right now. If you take a look at a quick comparison between Intouch, ProntoForm, SurveyMonkey, and Medallia, we were down 37%. Everybody else was up double digits. Why are we down and they're up? Because we have that services business, which we had to put on pause because of the pandemic. But that's going to change. That's not good. That's not permanent. That's a pause. And that's reflected in the fact that our sales multiple is 1.3 times. Their sales multiples are 4 for the smaller ProntoForms and 9 times for the big guys. Right? At the same time, while we're the only one with a negative growth, we're also the only one with a positive profit during the same time period. So there's room for us to see not only that revenue growth come back and get us back where we were and well beyond and back on our previous trajectory, but there's room for multiples to start to look like software multiples. So I think there's just a great opportunity. And when you take a look at capitalizing on that opportunity, we have to look at the fact that the customer experience management is a large, existing, and fast-growing market, maybe more so this year, frankly. We have a loyal customer base, strong technology, which helps businesses measure and deliver operationally for their customers. And that combination of software and services in a single platform provides true market intelligence. And we have a business model that is conducive to recurring revenue as well as SaaS growth and getting towards those SaaS multiples. So with that, I will put my last slide up here, which is a simple thank you slide and some contact information, and I will take a look and see if anyone has any questions. So I've got a question here. Do you have any cornerstone investors? What is the free float? And please discuss trading liquidity. The only cornerstone investors really are the ones that I mentioned, which were myself, Michael, and Eric. We don't have any. We have large brokerage firms that buy shares that they distribute with their, where you have a large broker who distributes to his hundreds of people, and they've been interested in the story and buying things. We have that with a number of brokerages where they're actively, actively over the years buying our stock. But we don't have any large investors that are below 10% or that are not insiders that I'm not mentioning. Everybody else is fairly distributed. And by free float, what I meant was those are the shares that are not held up by insiders. Those are the shares that are out there that, again, that we don't know who they're necessarily with. They're kind of not tied up where I can put a name on it. And then in terms of liquidity, I believe most of our trading is done on the TSXV. We're actually not on the CSX, we're on the TSXV. And I believe most of our trading is done there. The OTCQB, we have not done very much. We don't do investor relations work per se, very much on a proactive basis right now. And when we have done it, we have not done anything or very little in the United States. And the OTCQB is a relatively new listing for us. It's only a couple years old, so I believe it's mostly on the TSX is where we see most liquidity. Next question I have here is, what are the 1 to 2 things investors should look for in 2021? I think in 2021 there's a couple of things investors should be looking for. One would be the SaaS products and the software. as we start to see those products improve in the marketplace, and we start to see those back to the previous trajectories that we were on before 2020. I think that's something to keep an eye on. We will actually start reporting SaaS metrics a little bit more during 2021. We have plans to start creating and reporting on 2020 on SaaS-style metrics, which we have not done previously. So we're going to start doing that. That's something to look for. The other thing to look for is just going to be a return to our previous trajectory, our previous positioning, our previous growth. You know, as the world reopens and as it's been reopening, we're continuing to just get the benefits of that from work we did to keep the groundwork there in 2020. Are there any? I'll just look to see. I have to refresh here. Apparently. Somebody asked if there's any updated guidance. We have not provided any updated guidance to the market at this point. I will tell you that, you know, what I put out in Q3, which was and there was a trajectory there, and what I stated in the MD&A guidance from Q3 is pretty much where it is for the end of 2020. I think if you take a look at the numbers that we did report at the end of November through Q3, you'll see that it's obviously going to be a relatively strong year for 2020. We have not put out guidance for 2021 yet. We will look to do that in the spring. We have hesitated a little bit just because there's still so many unknowns that we don't control around provinces and states and opening and closing and what they're allowing businesses to do and not do. Unfortunately, we don't control it all, so we are still paying close attention to it. But I can tell you that, and I think I put this in one of my previous published things, 2021 will obviously be much stronger than 2020. And we will look to that guidance as we head out further into the spring. Our next question is, are you open to share buybacks should the market ignore the company as you return to growth mode? Yeah, absolutely. In fact, we had a normal course issuer bid out for several years. We bought shares back for a number of years for that exact reason. So, we don't take anything off the table as it relates to ensuring that we can create the type of value and the type of strength that we need to for our existing shareholder base. And we don't rule anything out, including things like normal course issuer bid or buybacks. Next question is, what do you see as Intouch Insight's biggest risk? There's a good question. I feel like if I was in an interview, I'd say it's that I work too hard as my biggest weakness. Got to come up with one of those. But our biggest risk really is, for 2021. Is really the global economy from the services business side. I don't think, I think our software is solid, and it like all software, the overnight success story takes years to be overnight success. But the services business is reliant on businesses being open and serving the general public. So right now, we're concerned that if people start shutting things down again, obviously in the U.S., where most of our revenue comes from, things have remained open. Now, of course, with the change in leadership coming on the 20th of January, we could see something change. If we start to see federal shutdowns, if we start to see more state shutdowns as a result of that change in leadership and direction, that could have a short-term impact on us because we can't control what governments do. Obviously the Canadian situation, which has lots of shutdowns, has already been built into our plans. America, going the same direction would be a risk for sure in terms of the biggest thing we're keeping an eye on for next year. But we're optimistic that with the vaccines rolling out, and that with a lot of states not really wanting to listen to that direction, that we will continue to see the American companies open and running and operating, and we'll continue to see our customers doing business with us and continuing to return. So that's our hope and thought. But certainly, there is a risk for sure around the first half of 2021 as it relates to the global economy and businesses staying open and operating, which is sort of required for them to keep paying us, I suppose. But we're not worried about getting the software traction. We're just worried about, again, it becomes a timing question because people also tend to not make those types of decisions necessarily during global pandemics sometimes as well. And I think that's all the questions that I had here, and I think we're also out of time. It's 2:30, so I want to thank everybody for their time and attention today. I hope learned a little bit about our company, and we look forward to having. Thank you all who are existing shareholders, and we look forward to hopefully having some more of you as new shareholders. Thank you.
And that concludes this webcast. Thank you.